Hello and welcome back to another video from Marcel McDermott. Just wanted to give you a kind of a head start on the budget project. You'll be working on two worksheets. This is a sample master budget for the XYZ company for September 30th. This is your beginning balance. You're going to be projecting October using the assumptions on page 1. You start with the beginning balance sheet. These are your beginning balances. This is some inventory information about. You've got $500 worth of inventory, and you've got item 1 and item 2, 8 units of item 1, 10 units of item 2. The cost of the item 1 was $25 per, and the cost for item 2 was $30. So that's the detail there. This is your desired ending inventory units for October. What you're going to do is you're going to use the same cost of 25 and 30 to calculate what your ending inventory dollars would be. Here's your assumptions for your sales, and here's some additional assumptions that we'll go through. I'm going to share with you. This was a sheet that we did in class, and I kind of walked through some of the stuff for the students. So these are our assumptions, and right here, the September 30th is the beginning balances. This is your inventory actual for September, the $500. You can see here I took the units for item 1 and item 2, multiplied them times the cost to come up with a projected $610 ending inventory dollar amount. Okay, and that number will be the number on the balance sheet that you're going to create. The next thing we did was estimated sales on account, which are really credit sales, and it's simply going to be the 20 units times the $50. That's the selling price. And just note that the selling price of the item, we're a retailer. We're going to sell it for $50 for item 1 when we bought it for $25. The same thing for item 2. We're going to sell it for $30. Sorry, we're going to sell it for $70 when we actually purchased it for $30. Okay, so pretty healthy margin on that. And then as we go through the items, 25% of September's accounts receivable and 50% of sales are expected to be collected. What I did is right above here, I took 25% of the accounts receivable balance, $1,000. 25% of $1,000 is $250. Next thing I did was I took 50% of sales are expected to be collected in cash. So what I needed to do was take 20 units times the selling price, 40 units times the selling price for item 2. I got $1,028. If I add those two together, my total sales is $3,800. Those $3,800, those are all credit sales, but 50% of them will be collected. So therefore, 3,800 estimated sales times 50%, our estimated cash collections will be $1,900. The next item is talking about accounts payable and purchases. 30% of September's accounts payable and 50% of purchases are expected to be paid in the month of October. Therefore, I scroll up to my beginning balance sheet. I see that accounts payable is $3,000. $3,000 times the 30%, I end up with $900. That's how much I'm estimating that I'm going to pay for that. The next item is purchases, which I've got it calculated here, but we actually have to do the purchase budget before we can calculate that number. And we'll talk about that in a bit. We've got interest on the notes payable of 8%. It's paid monthly, and it says round to the nearest dollar. Also, $400 of principal is due in October. Well, we've got $1,000 in our notes payable times the 8% equals $80. That's the yearly interest, but we only need the monthly interest. If we divide the yearly interest by 12 months, we come up with $6.667, and if we round to the nearest dollar, that would be $7. Also, note that on the note payable, the beginning balance of 1,000, if we're paying back 400, our ending balance for 1031 is going to be $600. And again, I'm putting that all on the assumption page so that you can see that. Depreciation was calculated using straight line depreciation. Equipment was purchased on September 30th and is expected to last 5 years. Okay, so if we look up here, we've got $2,000 worth of equipment. We divide that by 5 years. We come up with a depreciation expense for the year of 400. But since we have to do it for the month of October, we divide the yearly depreciation by 12, and we come up with 33.33, and we're going to round that down to $33 for the depreciation expense and also the accumulated depreciation on the balance sheet for the equipment. The next item we have to calculate is the computer costing $500 is going to be purchased on account or for credit, and it will not be depreciated until November. Okay, so we're going to take the $500, we're going to add it to the beginning balance for the equipment of $2,000, and then at the end of October, our equipment is going to be $2,500. Also, I put a note here that we have to add $500 to accounts payable because we didn't pay cash for the computer. We purchased it on account. The next assumption is the expenses we're going to have for October. Salaries of 500, advertising of 100. And then it says you need to calculate the interest and depreciation, which we actually already did. So if you want to calculate the total expenses, projected expenses for October, salaries minus 500, advertising expense minus 100. We calculated above interest expense of $7, and we calculated depreciation expense of 33. If you're to add up those four expenses, you would come up with total expenses of $640. Excuse me. Okay, so now that we've got our assumption page, and I'm gonna scan this and I'm gonna send it to you so that you can use this to do you're gonna have two worksheets. You're gonna have one for October, and then you're gonna create your assumptions for the November one. Okay, so again, I would suggest you do the same thing, and then you'll use these assumption pages to answer and fill out the budgets. So I'm going to switch to another document here, and this is basically the document you're going to see. It doesn't have anything filled out, but again, you can use my assumptions for the first page. What you're going to start doing is constructing these budgets. So for the sales budget, you've got item 1 and item 2. You're going to put the quantities from the first page in here, and you're going to have, for the sales, we're going to have 20 units and 40 units. We're going to put that into the sales budget, 20 units and 40 units, and then we're going to multiply it by the selling price, which again, if we go back to the first page, we can see that we're going to sell item 1 for 50, item 2 for 70. Okay. So once we do that, now we've completed our sales budget. The next budget is a little tricky, and that's why I kind of put some additional text in here. These are basically units for your sales, units for your ending inventory October 31st, and then if you add those two together, you get your units required minus your beginning inventory units equals the units you need to purchase. Once you have the units that you need to purchase for this level of sales and this level of ending inventory, less what you already have, that's going to tell you how much you're going to need to purchase for this one. Okay, so again, just note that this is units, 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 units. This is the cost of the inventory that you're going to get from the assumption page. So if you go to the assumption page, the cost of the inventory is going to be 25 and 30. Okay, this is your ending inventory, so 10 and 12 units. Your beginning inventory is 8 and 10 units. You're going to sell 20 and 40 units, and then you can calculate the rest from there. And basically what happened was when I calculated that, it came to 1810. 1810 was my total purchases, and you can see on item number 2, 50% of purchases are expected to be paid. 0.5 times the 1810, 905 of those credit purchases are expected to be paid in cash. Okay. Moving back to the sheets, we're going to go here. You're just going to drop in your expenses here. That's going to equal to your total expenses, I think, of $640, which is going to go on your income statement. Your capital expenditure budget, that's basically purchasing assets. You're buying the computer for $500 on account. Don't forget to increase accounts payable for that. Moving to the cash budget, you're going to take your beginning cash from your beginning balance sheet. So in this case, you're going to take the 5,000 beginning cash, and you're going to drop that on the first line here. The next thing you're going to do is collections from customers. The collections from accounts receivable, that's basically this number one item here. You're going to collect $250, the 25% of the beginning balance. That's going to be your first collection. and then you're also going to collect 50% of your credit sales. Your credit sales are 3,800 times the 50, 1,900. You're going to drop that right in here. You're going to add your beginning cash plus your 2 collections. That's your total cash collected, minus what you're going to pay out in accounts payable, your 50% of purchases, your salaries, your advertising, your interest. Also, here's the payment on the note. Remember, we're paying back $400. If you take all of your increases, your cash collected, minus your cash outflows, you should get an ending cash balance, which you're going to use that number on your balance sheet. Okay? The next thing is we're going to do our income statement. Our sales is 3,800. That's our projected sales. And to calculate our cost of goods sold, we're going to do it a little differently. We're going to take our beginning inventory dollars. I think it was, let's see, how much was it? Beginning inventory dollars was $500, and my purchases was 1,900. So basically, I'm going to take $500 plus the 1,900, and then I'm going to have my good. That's going to equal my goods available for sale, minus the 610, which is my ending inventory, is going to calculate how much my cost of goods sold is. Sales minus cost of goods sold is going to equal gross profit. Gross profit minus my total expenses, salary, advertising, interest, depreciation. We're going to take gross profit minus total expenses. We're going to come up with a projected net income. We're going to take our beginning, for the statement of retained earnings, we're going to take our beginning retained earnings from our beginning balance sheet plus our net income. We don't have any dividends, so it's basically going to be our beginning retained earnings plus the current month's net income. That's going to equal our ending retained earnings that we're going to use on our balance sheet. And then to do our balance sheet, we're going to take the cash from the cash budget. We're going to take the inventory from the first page. We're going to take our office equipment, the 2,000 plus the 500 for the computer that we bought. We're going to subtract the $33 of depreciation, and we're going to calculate our total assets. Don't do accounts receivable just yet. The next thing you're going to do is your liabilities. We know that we had $1,000 of notes payable. We paid back 400, so therefore we now owe 600. Our capital stock hasn't changed, and then we're going to take our retained earnings from our retained earnings statement. Accounts receivable and accounts payable is a little trickier. You start with your beginning balances for both. Item number 1, remember we collected 250 of accounts receivable, so we have to subtract that out. We then take the balance, we add our credit sales to it, and that's going to give us our ending balance for accounts receivable that we'll put up here. Next, for accounts payable, same thing. We've got our beginning balance minus how much we paid in item number 2 on our assumption page. That's going to give us a balance, plus 50% of our credit purchases, or 50% of our purchases are credit purchases. We're going to add that to accounts payable because we didn't pay cash for it. And then we're going to get a total or a subtotal, and we have to still add that $500 for the computer. Once you do that, all your numbers should tie out. Your total assets should equal your liabilities plus stockholders' equity. For the master budget project, you're going to need to do October projections, and then get your balance sheet to balance. Then you're going to need to do November's projections and get that to balance. Once you do that, then you'll be able to do the master budget project. Okay, I'll have another video about that, how to use the template to complete the master budget project. I hope you find this helpful. Thanks so much. Take care. Bye-bye.